Uh, we're apparently on to talk about Monday morning movers. Well, then there you go. Okay. Well, good to see everyone again. Right? The irony of that statement. Anyway, Monday morning movers. What should you be looking out for if you're in the markets on this most magnanimous Monday? Well, it is, whatever day it is, the 12th of January, right, 2024. So what is happening in the markets around now? Well, you're kind of in the heart of winter in the Northern Hemisphere. So a lot of people are buying things related to that particular season. And that's consumer stuff. Does that affect trading and the VEPs? Not so far as low time frame scalps go. No, it doesn't. Does it affect the longer term investments? Things like stock prices for the longer term. If more people are buying ice cream in a particular season, does that really make the value of that company go up overall? If 5 weeks later they're back to normal, it depends on how much they bought extra, right? If they actually bought so much extra, if they have a new record year over year, or they have a new, overall, whatever it is, global revenues for the year, something like that, then sure, arguably it has an impact if their profits are up, right? But a lot of times you see stock prices going up. Again, it's not because of the news, but you'll see stories about stock prices going up or down. And they'll say this company, is selling more whatever product, and therefore their stock prices go up. That really isn't at all how that works. A classic example is a story about Chipotle, which is a food chain restaurant. They sell, I guess, Mexican style food, burritos and things like that. And apparently, between the months of March, April, and May, they sell something like 20% more burritos. Okay, and the news story is that the coverage is all about how when that happens, it impacts their stock prices because some analyst said something about it, right? Well, again, if you know anything about trading the VEPs, you'll know that, usually when analysts are talking, they're lying, right? They're either saying something they don't know about, or they're definitely not telling the truth about something they do know about. So, take their advice for what it is. I would urge you not to take their advice. And bear in mind what their interests are, as opposed to what the VEPs are telling you. Now, I'm not saying buy or don't buy Chipotle. I haven't looked at their chart lately. Don't know what to tell you about that. And I'm certainly not a financial advisor. So, I'm just saying, it's funny how the classic news traps are still in effect in 2024. Even after I saw a hilarious story about how, quote unquote, volatility is back. Right? Some reporter like, Fox Business or CNBC or one of those channels, I really don't remember which one, Doesn't really matter. But one of those reporters was asking like Warren Buffett, saying volatility is back and it's scary. What do we do about it? And then he gave his usual shtick answer. And it's hilarious because the only reason that such a comment would even be made is because it's in fashion to say that word even though people have no clue what it means. Volatility is back. No, what they mean is that there's a lot of price action happening because they don't actually know what volatility is, those reporters, for the most part. I can assure you volatility is something that Warren Buffett knows about. But the average trader does not, and neither does the average news reporter. So, yeah, it's just kind of funny. Like, they use these words like they have any comprehension of what they mean, when they clearly don't. Right? They might as well say, slippage is back, right? Or anything. It's just such silly nonsense. What I can tell you is that volatility has always been here in markets that are trading, inefficient markets that are trading and that are generally random markets. Right? As long as there are inefficiencies in any market, there will be volatility. Well, how do you get volatility in a market? Well, free markets operate great with volatility because buyers buy, sellers sell, and they sell and buy, or they offer their sales or their purchases at whatever price they want because it's free markets. Managed markets, like we actually have in the real world with regulations, rules, and artificial synthetic injections of fiat currency, etc. Those things, they're also markets where there's volatility, but it's so synthetic that you have to be very aware of all those things in order to participate safely and not get screwed over by the theatrics of the banksters in charge. Right? Like, for example, right, we have artificial liquidity, right? When the Fed or any central bank decides to do a cash injection. Right? When the central bank is participating in the free market, first of all, that's a problem because they're supposed to be a bank, not a trading house. And they're supposed to be a central bank. In other words, they're supposed to be providing capital, or the Federal Reserve is supposed to be providing capital to the government and to financial institutions, etc. Right? They're not supposed to really do much else. But over the years, it's become more and more of an investment house, right? For themselves, not for the general public, of course. And by that I mean, well, a few years ago, during this thing that happened that shut down the world economically for quite some time, almost a year, at some point during that period, the Federal Reserve actually owned something like 20% of all stocks on the market. Now think about that. The very organization that prints the money, that pays for the U.S. government to be able to pay its bills, and gives money to other wealthy institutions, and is owned and operated by bankers from those institutions and others, um, they owned 1 in 5 stocks on the market. And when you consider that about 90% of people in America don't even own a single stock. Think about that. They don't even forget a stock, not a commodity, not a forex, not a crypto, nothing. The average American does not participate actively in investing or trading in markets. It's only the top 10% or so who own about 80% of the stocks that are held by retail. So think about that. Who is it that actually owns the stocks demographically? Who are in the top 10%? People who are born wealthy from wealthy parents. That's a very, very small percentage of people. Okay, who else? Oh, rich doctors. Yeah, sure, there's some who care about the markets enough to invest in something. Rich engineers, sure. Rich lawyers, sure. Mostly. A lot of rich people working in finance. They actually own the most of them because they typically know more about this topic than other people. So, an entire industry, right, where the most self-interested parties own the majority of the product available to that particular market, the retail investor market. Now, what does that tell you? In a sentence or less. Something typical. Yeah, the sentence is that the dealer's getting high on his own supply, effectively. Right? The people who own the overwhelming majority of shares available in the retail space, or held by the retail investor space, are traders, investors, like professional investors and traders, and other people in finance. Do you see a problem here? Because I do. Right? And you wonder why, stock prices keep going up long term. There's natural drift. Yeah, there's natural drift because of mathematical reasons. The mean, the variance, volatility, the entropy, etc. Over time, prices go up as fiat buying power goes down. Therefore, you need more fiat to buy a share of the same stock next year or 10 years from now than you do today. That only makes sense in that sense. But the other reason is because the people holding these things long term are self-interested in seeing it go up. Right? The longer they hold, the longer it goes up, etc. Self-fulfilling prophecy, and they work in the industry. So they know very well how it works. And they don't have any interest in selling. If anything, they're going to keep holding. So, that should be another red flag for you if you don't think that we live in a managed market. We live in a managed market with extremely slick professionals who are managing it. You want to call it a regulated market, whatever. It's managed. It's beyond regulated. It's fully managed. And what you get as a trader, as a retail trader, is you get to pick up the crumbs that the big sharks and the big whales can't be bothered to pick up. And if you pick up enough of those crumbs over time, you can be one of those whales. But it's a slow, steady process as opposed to getting rich overnight or something nonsensical. Because easy come, easy go. People that usually make a fast buck, they tend to lose it just as quick. And the evidence for that is mathematically provable. What do I mean? Well, literally what I just said. So, if somebody earns whatever it is, an average salary, doesn't matter, and suddenly they pull a trade and they, get a 10x profit on some relatively big trade for their position. Right? Maybe $1,000 is a lot to them, and they put $1,000 into the market, and somehow they 10x'd it, and they got 10 grand profit. Right? Then that's a big deal. Okay, for them. That's the assumption here, just for easy math. So if 10 grand is a lot for them, and suddenly they have such a merry amount, then what do you think is going to happen next? Yeah? You think they're going to take that capital? They just want on a gamble, most likely. They're going to take that capital and reinvest it? Or do you think they're going to take that capital and quote unquote live a little? Maybe pay some bills, buy some necessary things, buy a few things that they want to buy, go out, travel, who knows what. Yeah, if you answered the latter, you're more than likely correct. Most of the time you're correct. It's the rare exception to the rule that will take that money and just reinvest and reinvest and reinvest in a methodical way. But more importantly, also trade in a methodical way so that he can actually invest in the gains. Because if they're trading like most people, then they're just losing money most of the time. So there's nothing for them to reinvest. They can think about reinvesting, but they're not actually going to do it. Right? They're just going to actually invest and lose, invest and lose, invest and lose. So, what does that mean? Well, basically it means that the average retail trader doesn't really have much of a chance of ever making significant gains. And even if they ever do, they're not going to hold on to them because greed, because creatures of habit, because life is expensive, and because they have to take care of things like bills or whatever, financial plan, etc. So they're not going to do what they need to do to actually learn to trade properly. And so their win is kind of haphazard and random. They can't count on regular wins because they're going always for shooting for the moon. Right? They may as well be just buying lottery tickets. And for the most part, that's really what they're doing. So they're just buying effectively lottery tickets by some other name. Stocks or commodities or Forex or crypto or whatever. then what is the point of what they're doing? Why are they doing it? Well, you can't really assume people's ambitions or motivations. If you assume people's motivations and ambitions, well, you're making a mistake. Because first of all, it's moot, irrelevant. Second of all, you can't possibly know because there's too much randomness in the market for you to know everybody's private thoughts. Even if you know somebody intimately well and they tell you all the reasons that they're doing something, you don't necessarily know that there's not also another reason. There's too many. How many stories are there of people being betrayed by their closest friend or ally or whatever? They thought their ally was going to do something, turns out they did something else, or they actually knew what their ally or friend was going to do, and their ally or friend didn't, for an entirely different reason. How many novels are written about that theme? It's almost endless, right? So if you can't pigeonhole, and you shouldn't, why retail does what it does, that's actually good. Because it means you can ignore that aspect since it doesn't factor in. So what does factor in? Well, what factors in is that retail traders are, for the most part, just gambling. That's it, they're just gambling. Retail traders are, by and large, using lagging indicators that only tell them information about what has happened and not what is probably going to happen. Retail traders only know about information that is looking backwards. That's why it's lagging information. Nothing of it is forward-looking. Well, they'll tell you it's forward-looking, but it isn't. Or they'll think it's forward-looking because they've been told it is, but it isn't. So, what should you look for in such markets where you have we're not calling them puppet masters, you have the market managers managing the market very well, very tight, right? Taking profits on a regular basis, using leading information to do so. And they are pushing lagging information onto the rest of the market. And they're getting the rest of the market to buy into it because they're using some of their money, of which they have practically an unlimited supply, to convince people that these lagging indicator tools are the best way for retail traders to trade, when they know full well that they are in fact not. And not only that, they know more than full well. They avoid those tools like the plague. They would not themselves use these tools to trade anything, because they know how terrible those tools are. They know that they're going to fool most people pretty much all the time and make people fail to trade properly most of the time. And therefore, they're going to cause people to lose their trades most of the time. And therefore, they're going to cause people to lose their money most of the time. And it's practically all of the time. But there's a tiny, tiny, tiny percentage that will always beat the odds. Those are the outliers. And they beat them for a certain percentage of time. Usually that's short-lived. Some will do longer term better, but most of them won't. And when you consider how vicious that market is, it's literally a bunch of sharks and a bunch of whales going after a bunch of minnows or whatever. Come to realize the single best way for any retail trader to actually have a chance in hell at winning any amount of trades regularly and to be consistently profitable is to trade with leading information, like the VEPs, the volatility, the entropy, the probability, and the statistics. Now, if you're not yet familiar, I highly recommend that you go to the Alpha Trading Discord. Get there by going to alphatradinghq.com, clicking on the Discord link. It's in the menu there, or just typing in alphatradinghq.com/Discord, and you'll end up at the Discord of Alpha Trading. Why should you do that? Well, because they give away, for free, no cost, zero money, indicators that you can use to learn how to trade, and you can actually trade with them. Volatility, probability, and statistics. Free indicators. If you're familiar with traditional TA tools, the type that they have on TradingView, well, you'll see that these are not that different looking. Columns, bars, lines, etc. Okay? And you'll get a free set of tools, which includes historical volatility in the alpha volatility percentage indicator, as well as the Alpha Trading Pearson correlation indicator. When you combine those two indicators, it will literally tell you the tendency of the price action with an extremely high degree of accuracy. And you'll get the alpha laser returns indicator. On top of that, the alpha laser returns indicator shows you when returns are increasing or decreasing, either positive or negative. Shows you the slope of them. Even shows you divergence between the returns and the price action. So when there's a divergence move building up or about to happen or happening, you can see it. Returns divergences are really the only ones that matter. That matter. You hear that? They're the only ones that matter in trading, because price action follows returns. So you don't make divergence using price action tools. You make divergence using tools related to returns. You can also use them based on entropy. That also works very well. But returns, by far, are the best. On top of that, you get the alpha volatility quality indicator, which, by the way, is freely available. You don't even have to go to the Discord for that. That's just, you can get that from the Alpha Trading TradingView account. The Alpha Trading TradingView account. It's on their profile. just click on the indicator and add it to your chart. That will show you the quality of the volatility. Why is that useful? Well, that is useful because that will show you whether or not the volatility quality is good or bad, whether or not you should be entering a long or a short, or exiting a long or a short, or staying in it. It will show you very nice moves you can hold on to. You know, you may not necessarily get in on the very first candle or get out on the very last candle, but you will generally get the bulk of the move. And it is highly directional. If you know how to use it, it is extremely directional. So, that's 4 indicators. 2 of them act as a pair. 4 free volatility-based indicators from Alpha Trading. Not only that, they'll give you a chart that you can put it on. You literally just copy the chart, add it to your trading view, and learn to trade absolutely for free. Right? They're never going to ask you, hey, you know, you got to pay now, you're going to pay now, you're going to join. They don't care. Do they have a pro version of the tools that costs a bit of money? Yeah, it costs a bit of money. It costs like $3 a day. It's like $100 a month, not even $99 a month, right? Which is a joke in the indicator world, where they typically charge $200, $300, $400, $500 for a single indicator. Alpha Trading's pro indicators gives you like dozens and dozens of incredibly well-tested volatility, entropy, probability, and statistics leading information indicators. Right? Literally dozens and dozens of them. Why? Because the tools were made by the traders of Alpha Trading, the co-founders, who actually trade. So they're not going to make tools that they don't use. They made tools for themselves because they were sick and tired of all the garbage tools that other people have, and they were sick and tired of all the not such great tools that even one other volatility related group had made, mostly because the people in that group had issues and were very mean and nasty, unpleasant people. So Alpha Trading decided, let's make our own friendly group of people who want to trade volatility, right? And not be mean and nasty to anybody who wants to learn this stuff, because it's not intuitive, right? We didn't have anybody holding our hands and showing us the way. Fortunately, that's why we created this group, is so that we could help people learn faster and not get wrecked by all the things I've just pointed out to you about the markets. So that's what I recommend happens this Monday morning in the Monday Morning Movers update. If you are trading, I hope you're trading volatility, entropy, probability, and statistics. If you're not, well, you know where to go now to get those tools for free. Right, they have live streams, usually 5 days a week, right around market open, sometimes different times of the day. It's a Discord, just some channels of information. There's people who are happy to answer any questions. If you ask a question, they get tons of answers, and they're all using the same information, right? And they're all going to explain it well to you, right? Unlike other Discords where you're going to get 1,000 different answers, they're just going to confuse you. And Alpha Trading, all the answers will just fit more and more into your puzzle that makes sense to you. It'll decrypt for you. Anyway, that's it. Happy trading.